Hello and welcome. You're watching KYC, which is Know Your Company. Today we're going to focus in on Jyoti CNC. It's a niche business again, and that's why it's very interesting. Took me some time to understand the business itself, but let's quickly dive down on what I want to know about this business more than anything else. It currently trades at 90 times price to earnings. Certainly not cheap by any standards. Question is, are valuations justified just given the growth potential? So that's something we'll try to answer, and of course we'll get insights from the management as well as to what they believe the growth trajectory is going to look like, and therefore what the potential is, and therefore whether valuations actually justify that kind of potential, because we are looking way out in terms of valuations or earnings multiples starting to normalize. So that's the one big piece that I want to understand. Second one, it's a specialized business. So what opportunities will it capture? Because as of today, it is the only component manufacturer selling to EMS companies, which is electronic manufacturing companies. Now, when you're looking at an opportunity which is that large and you are the only player, of course, you are virtually like a monopoly. But what happens when other players start to eat your market share, at least the domestic market share, for among the EMS business? And therefore, that's something I want to really understand. What opportunities will it capture going forward, and what happens to the opportunities it's already captured? So something I'd want to understand. The third piece is with regard to Hurun, its manufacturing facility in France. Again, there's a big turnaround in Europe, which is already at play. I want to understand whether that opportunity is getting adequately captured already with what the markets are anticipating, or is there a larger opportunity over the next couple of years? Because that opportunity we're not fully clear with regard to how large it is and how Jyoti will capture it. And therefore, that's the other thing I'd want to understand. Working capital, there is some pressure with regard to working capital. Clearly, your working capital days are way too high. You want that to come down. They've guided for it to come down in FY26. What gives them that comfort, and how much can they bring it down by? Because that is eating into cash flow from operations. We'll see it in the metrics. And that's the other thing I want to understand. The last piece is with regard to capex plans and funding. You have obviously this extremely large opportunity, but capex, just to put it into perspective, they're going to take 6,000 machines, which they currently have a capacity for, and increase that to 16,000 in the next 12 to 15 months. That's a very, very large increase in terms of capacity itself. And therefore, what is the funding, sustainability of return ratios as they ramp up is really the question I will be asking. So large capex plans, how do you fund it, and what's thereafter, what lies is what I want to understand. So that's how it all stacks up with regard to what I want to understand. But let's quickly zoom into what the company does. And this is where it starts to get very interesting. And I'm going to try to break it down. Let's look at what it does. It is the leading manufacturer in India of 5-axis CNC machines. I'm going to try and break down what a CNC machine is. A CNC machine is a computer numerical control machine. Typically, when you want to make a niche component or part, think of it as an auto component, a nut, a bolt. You typically will need a 3-axis machine, which goes on the side and down. A 5-axis allows for a rotation and a more nuanced component to get made. So that's a 5-axis machine. Jyoti is one of the players which manufactures this 5-axis machine, which allows the manufacturing of a component by the machine moving in all directions. There are, of course, 6- and 7-axis machines as well, which are far more or higher in terms of their niche, but the 5-axis itself is a very, very high niche product. In India, you have around 10 to 12% market share that Jyoti caters to, and 50% plus is catered through import. So the import substitution potential for this machine is extremely high. This is where it stands out versus some of the other players. It allows, these are broadly the type of products it manufactures, okay? I won't get into the nuances of the products itself, but it's a niche component manufacturing capex machine, which allows you to manufacture niche components within the aerospace, auto, transport segments, right? Instead of the 3-axis, it uses the 5-axis. That should kind of cap it off. What does it enable? It enables complex design of machine parts. It enables high accuracy, reduced time, and it also enables lack of manual intervention. A lot of this is done completely automated, which is the big positive. Now let's talk about what it caters to and what industries it caters to. The new products that it caters to is medical devices, toys and drones, which is on your screen, but it's largely utilized in electronics, telecom, auto, aerospace, medical, transport. This broad breakup of where all it is utilized. Now I want to also talk a little bit about some of their clientele, because that gives us deep insights into what is the kind of niche product that it does. Its clientele includes HAL, which is HAL, Tata Advanced Systems, Airbus, you have a GE, a Rolls-Royce, a Safran, Boeing, again the defense manufacturing of Bharat Forge, you have a Tata Motors, a Mahindra within the auto space, a Volvo, a BMW, a Mercedes, an Audi, a Volkswagen, an Ashok Leyland, a Fiat, and then within even the others basket, you have something like a Harsha Engineers, you have a Titan, a Bosch, a Havells. So you get the kind of diversity in terms of clientele that Jyoti deals with, and broadly the components and parts used in some of these industries are what Jyoti helps. So it's a pure B2B, helps other businesses with. That's how it stacks up in terms of clientele as well. Now let me quickly also take you through its presence and its manufacturing. It has 2 facilities, one in Rajkot, where they have more land as well to allow them to grow, and the other one is in France. And this is their Huron facility in Strasbourg in France. They had bought this in 2007. Important to understand some dynamic around this. Okay, so let's first talk about the India capacity. They've grown the India capacity from 4,400 machines per annum to 6,000 machines per annum. Their current capacity utilization is around 85%. So it's nearly at full capacity utilization. There is an expansion plan in India to expand the current facility to enable manufacture of 10,000 more machines. So taking the total to 16,000, okay, by end of this financial year. Capex of 400 to 450 odd crore will be undertaken for this, and this capacity will come on stream as early as June 2026. So in the next 12 to 15 months, you'll likely see this capacity come on stream. Let's talk about Europe also a little bit. There's been some bottlenecking which has happened there. So the top line of around 400 to 450 crore coming from Huron will now go to 800 crore as a result of this debottlenecking. Again, this will happen maybe in the next 2 to 3 months. So we'll try to understand how these timelines will work and how demand is shaping up in both of these markets. But let's talk a little bit more about Huron. It was acquired in 2007 for 16 million euros. At that point, the top line was around 33 million euros. Currently, and that top line was largely flat till 2019, so no change. But what they did was they utilized some of the R&D sitting in Huron in India to try and do product innovation, and that's exactly what's helped the numbers. So by 2023-24, Europe had also picked up. The order pipeline from 2023 to 2024 sitting currently is around 2,000 crore. So there's a large execution which is waiting to happen over there. And that's why that 800 crore push to potential top line looks likely, because you have a very large order backlog which is sitting there. even in terms of how the market dynamic is working, it's a highly fragmented market. The top 10 players hold just 30 to 40% of market share. So that kind of goes to show that the potential to grow from where Jyoti is in terms of global outlook is quite high. India, 55%, I did mention this, of the tools are imported. We are reliant on China, Japan, as well as Germany with regard to our demand. Where is the demand currently coming from? It's coming from electronic manufacturing players. That's the big play, right? They're literally doubling every year. And therefore, they really require a push with regard to setting up more capacities for which they require tools, and Jyoti CNC is currently the exclusive supplier of those tools among all Indian manufacturers. So something to look out for. They have a very, very large order book already. We'll talk a little bit about that, but we'll also speak with the management. We have Mr. P.G. Jadeja, who is the chairman and managing director, who we'll speak with at the end of this conversation. But that's a long enough introduction. Let me start off very, very quickly by looking at the parameters on this one. We'll look at the income statement, the balance sheet, the cash flows. We'll look at return ratios, shareholding, street cred. We'll look at outlook and valuations. Very quickly, we'll try to cover this. And let's start off with the income statement. You look at the growth in terms of the top line, extremely strong, a 35% CAGR over the last 3 years, and a consistent increase in each of the years. That's how the revenue has gone up, 35% CAGR. EBITDA has done far better at 86% CAGR. Profit after tax, I can't give you a CAGR, but it's doubled versus FY24, and honestly, it was negative in FY22 and 23. So the CAGR number may not apply, but it's doubled in FY25 versus FY24. So very, very strong growth clip that it's on. Let's look at the margin trajectory also one more time. Kind of gives us an indication as to how margins are going. Look at that, from 10% to 27% now. There's been a very strong tailwind and a very strong pickup, at least domestically led by the EMS play. Let's look at the balance sheet now. So clear thumbs up with regard to income statement. The balance sheet, there's some amount of equity added versus FY23. That's because of the IPO that they did, around 1,000 odd crore coming in to the other equity due to securities premium plus the fresh issue. You look at the book value currently sitting at around 1,700 crore. You look at borrowings, which is roughly 500 crore, but they've gone up quite sharply. But when I'm comparing borrowing to total equity, it's around 1:4, so fair amount of equity sitting there, or 1:3 rather. And then when you compare borrowing with the total market cap, which is around 28,000 crore, it's very comfortable, right? And therefore, we've still given this a thumbs up because it's a high growth business. You would expect some amount of borrowing on the balance sheet. Borrowing doesn't seem to be completely out of whack. 1 year of profitability odd should take care of that borrowing number. We did speak about how profits have doubled versus last year and around 300 odd crore. So you have a decent amount of profitability sitting to take care of a full payback of borrowing along with cash balances as well, if one wants to look at it. So no particular concern with regard to the borrowing number. Cash balance is also sitting at around 125 crore, not bad at all. So therefore, we switch to the cash flow. That's where some bit of tepidness starts to trickle through, right? You look at the negative cash flow from operations number and you look at the way in which profit after tax has moved. Cash flow from operations hasn't moved in the same fashion. That's because of increased working capital requirements, and this needs to come off. This is really the possible concern with regard to financials. So you want to look for how this will come off, how the working capital requirements will come down, and if that were to happen, you could well see cash flow from operations get much better starting FY26. But for the moment, we're giving this a thumbs down because we're not quite happy with the way this number is proving to be a headwind. Let's talk about return ratios now, because a large part of what they do in terms of free cash flow or cash flow in general is taken care of by reinvestment. They're doing high amounts of reinvestment. They're going to do another 400 crore of capex on a balance sheet size of 1,700 crore. So what you want to see is how they're doing on ROCE. And that's very strong because you look at the way ROCE has moved up and is sustaining around that 24% mark, 20+% over the last couple of years, gives good amount of credence to new investment to be made within this space. Let's look at shareholding therefore. Again, shareholding kind of shows that the promoter holding at 63% is reasonable. It's quite solid in that sense. FIs hold around 7% DIs hold around 10% public holds around 20%. And you look at the number of shareholders, they've gone up, but not materially. Between FY24 and FY25, the number of shareholders have gone up from 37,000 to 63,000. That's the journey of the number of shareholders as well. Nothing really materially incorrect in any of these. There is enough comfort here, and therefore we'll give it a thumbs up. Now let's look at street cred. Now you look at the 1 month performance, it's at 15%. 6 months year to date has been a little soft, no doubt, but understandably so. You look at the 1 year performance, 38% is the kind of return that this stock has given over the last 1 year. And since the listing in January, 2.8x is what the stock has done, even if you've bought it at listing. Therefore, it's given shareholders a very, very strong return. It's also left enough money on the table, because in Jan 24, there was an IPO which happened at sub 400 rupees a share. Currently sitting at 1200 rupees. Surely it's left enough money on the table for shareholders. So we'll give this a thumbs up as well with regard to how shareholders would view this one and the way in which the stock has moved. But let's look at the outlook now going forward. And thereafter, we look at valuations. This is how the outlook looks. In Q4 of FY25, they've delivered 1,350 odd machines. In full year FY25, they've done 4,070 machines. All of this has enabled it to clock a top line of around 1,818 crore in FY25. Now, when you're looking at current capacity, it is constrained. So what they're going to do is they're going to do a capacity expansion. But let's look at the order book first. 1,818 crore top line, order book sitting at 4,360 crore. A large part of that will come from EMS. EMS, which is electronic manufacturers, the orders will kick in starting H2 FY26. So allow them a quarter or two of softer sales in comparison, and the real pickup will start to happen H2 FY26. Of course, we'll take management guidance as to whether that currently also stands. Competition currently is sitting out of Japan, especially in the EMS space. Other than that, no domestic competition. The margin outlook is 25% for the foreseeable future. The new facility will add 10,000 machines. We did speak about it, and will go on stream from June of 2026. We spoke about that as well. 400 to 450 crore of capex on a 1,700 crore balance sheet, and Huron can do annual sales of around 800 crore post the new capex that they've done. So we've spoken about that as well. Around 80 million euros worth of sales, which we've just converted to INR to roughly 800 crore post the new capex that they have done. The risks, though, very important. Moderation in global aerospace demand, not bringing down working capital days, and execution of order book. Those could be potential risks, but those look slightly, that there is decent amount of comfort that they may not materialize. Let me put it that way. So that's how it's stacking up. Now let's look at valuations, because certainly no comfort there. With regard to the revenue, currently sitting at 1,818 crore, the revenue that broadly analysts have estimated, and there's only one analyst on the street, have estimated is around 2,700 crore. We've actually taken a 10% discount to that at 2,500 crore. Thereafter, we've built in a 50% growth in FY27, because mind you, that's where the real capacity will start to kick in, especially on the EMS side of things. EBITDA is as per guidance 25%. That means they'll do an EBITDA of 625 crore in FY26, 940 crore in FY27. They're currently at 28,000 crore in terms of market cap. I just want to flag that off. I've factored in around 100 crore of depreciation plus interest expenditure, thereby extrapolating the profit after tax. And that's where the PE currently stands. A 2-year forward PE of 45 times. No real players in this space, no major ones, like the way Jyoti is, and the growth that they are expecting. And therefore, we've not been able to kind of map that or compare that to others, at least for the moment. But that's how it all stacks up. A clear thumbs down with regard to valuations, and that's because it's an expensive story to buy into, at least at the moment. So keep your eye out on that one. Let's go though across straight to the management. We have PG Jadeja, who's the chairman and managing director of Jyoti CNC Automation, joining us. Sir, good having you, good speaking with you. Sir, talk to us about FY26. What's the growth number that you'll be looking at? Because you have a very large order book. There's plenty of work for you to execute.
So basically, thank you very much to giving me this opportunity to explain about 26 numbers and questions and all.
It's
I
our
was
pleasure.
watching. Yeah. So 26 will maintain similar growth trajectory what we are having into 25, because still our limitations is going to be at 6,000 machines, and we are optimistic to be utilized at 90% in FY 26 there. And that's the our focus area to be on that. The next facility will come on 27 there. Yeah.
So therefore, what should 27 numbers be like?
So in 27 numbers, let's say definitely we will have a better visibility. Let's say we will grow by on a similar fashion for a next 27 also to be there.
How long will it take to execute your full order books of 4,500 crore?
Basically, based on our run rate today, it is coming to be a 2.5 year. But we are planning to have a, let's say, around 18 to 20 months, we are looking to be executed to that.
Okay, so maybe in the next 18 odd months, you'll try to execute all of that. Excellent. Got it, sir. Sir, what's the downside risk? Because you're putting up large amounts of capex, right? Currently, you're sitting on a very large order book, but you're also growing capacity. So your current capacity, or rather once all of the capex is done by June 26, your capacity will sit at 16,000 machines. Talk to us about what is the downside risk to orders not coming at the rate at which you've put up capacity, because it's a very large capacity that you've put up.
So basically, let's say until last year, we were having a constraint. We have just removed the bottleneck and reached to a 6,000 machines. And based on capex, the size of operations, what we are doing, and what the let's say our book is allowing us to expand our capacity, and the market, basically my customers are growing everywhere, particularly in aerospace and defense. The way the geopolitical situation has been arise, and everybody, those countries has not been invested in last 30-40 years like in Europe. There this it's a huge opportunities are open up, and we are very much confident in Indian manufacturing story also over here, that here also a lot of manufacturing is going up, and particularly keeping in mind to on electronic manufacturing. This capacity is right now we feel it is from 6,000 to 16,000 has been very high, but as on today's what the pipeline we are sitting, it's still we need to another 2 years down the line we need to expand further more quickly there. That's kind of a wind we are able to see today.
Wow. So you will have to expand capacity 2 years from now, despite nearly tripling capacity in the last 12 months odd. Am I hearing that right?
Yeah, you are hearing right.
Okay.
And right now, let's say, you have to consider that 10,000 machines, what the capacity we are expanding is based on the model mix today. Okay. So today we are putting up into more into a general engineering and EMS and entry level product there. Okay. So we may not mind seeing in 10,000 machine average value what we are achieving to like that. Okay. But seeing in a next round of our capex after this 10,000, we will put forward to more into a large heavy machine for aerospace and defense to be there.
Got it. So, but aerospace and defense, do you see growth there? Because what we are largely seeing is a lot of your growth will be driven by EMS, at least at this point for the next year or two.
No, let's say this is going to be completely balanced there.
Okay.
The front runner is going to be a aerospace and defense.
Okay.
The EMS will pick up from this year and gradually will grow to the next 2 to 3 years there. But right now, the let's say the flight has been takeoff is more into aerospace and defense there.
Understood. Sir, would it be reasonable to say that Europe will contribute around 800 odd crore of top line starting this year itself?
No. See, this is a capacity.
Got it.
And capacity is going to come only on this next month only there.
Understood.
And parallelly, this is the capacity we have made a double, but to reach out this utility, we are going to take at least minimum 2 to 3 years time there.
Understood. So the 2,000 crore that you have in terms of orders in Europe,
basically all the maximum you will see that the highest growths and everything you will see in a more on a India business there. Huron is in our front end there.
Sure.
And all maximum manufacturing we are shifting towards India and sending from here to their customers there basically.
Got it. And your current order book in Europe is around 2,000 odd crore. You expect that to continue to grow, and how quickly do you execute there?
See, right now we have a lot of inquiries and pressure from our customers to deliver faster there. Right now we are not able to receive those orders because already we have delivery period is today is based on this capacity is 18 to 24 months or a 2.5 year like that. So no customers are ready to wait until that longer there. The way execution will be improved, the capacity will increase, this order pipe will increase a solid to be there. Right now, there are a good growth we are seeing into this all manufacturing sector over there.
How will you fund your capex, sir? There's capex which is lined up this year, as well as 2 years from now, you're saying there'll be more capex.
So basically, right now we don't have any borrowing in a capex. What you have, we were showing that is just some working capital. It's let's say today our net borrowing is close to 300 odd crores. It's not 497 based on the deposits and all basically. We have a good margin and we are able to fund from our own margin from this year there. We will see the very cash flow positive and able to 50% maybe fund from our own and we will borrow something more there because our balance sheets are allowing us very nicely to be there.
Understood. What happens with regard to working capital, sir? That's going up, which is what is impacting your cash flow from operations. Talk to us about why that is so and what makes you confident that that will come off. How much will it come off by in the current financial year?
I would like to correct also to be here that just look at that the 2 years back we were having a 330 days of inventory days. Has come down last year to be 234 days and this year it has come down to 181 days. So it's optimized very nicely there. And still this year also we are looking to be at inventory days to come down to 160 days there. So from 330 to 160 days, and it's a purely optimized now. And this is an industry's requirement. We are fully vertically integrated company. We do all our castings, we do all the precision machining, sub-assembly, assembly, and largely these are the backward integrations over here.
Point taken. Thank you so much, Mr. Jadeja, for coming in and explaining this. A very, very niche company. But very interesting nonetheless. So thank you for coming in and speaking with us. With that, that's all the time we have on KYC. Quickly going to mark out the ratings on our KYC metrics that we cull out. It's a very healthy 6 out of 8 with 2 thumbs downs on cash flow and valuations. Everything else is a thumbs up. But that's how we sum it up with regard to Jyoti CNC. Stay tuned. More action on the other side.